Let me ask you something. You've seen those headlines, right? A big investment bank slaps a buy rating on a stock. And you think, okay, this is it, this is the one. Well, today, we are going to pull back the curtain on that whole world and reveal the one big secret you need to know about what those ratings really mean. All right, let's dive right in. We're going to start by tackling a huge misunderstanding that honestly, even seasoned investors get wrong. And it's a mistake that could be quietly costing you a whole lot of money.
You see this kind of thing all the time. A massive firm, a bold buy rating, a really juicy price target. I mean, it just feels like a giant green light, doesn't it? A clear signal telling you to jump in.
But hang on a second. Is that what's really happening? Is this a straightforward tip just for you? Or is there something else going on behind the scenes that you're not seeing? Let's break it down. Okay, so here's the key to the whole puzzle. You need to know that the financial world has two totally different kinds of analysts. And once you get the difference, everything's going to click into place. So, first up, you have the sell-side analyst. These are the people whose reports you see in the news. Now, their job is to create research that their company can then, you guessed it, sell. They sell the report itself, they sell advisory services, or they use it to get people trading. Their research is a product. And then you've got the other side of the coin, the buy-side analyst. Their work? It's top secret. It's done internally for their own firm. We're talking giant mutual funds, hedge funds, so they can make their own private investment decisions. You will almost never, ever see one of their reports. And bam, this right here is the big secret. We all instinctively hear sell side and think, oh, they're telling people to sell stocks. Nope, not at all. It means their firm is selling a product or a service to you, the public. So that buy rating on Reliance, that's from a sell-side analyst. It's part of a sales pitch. So, what happens when we mistake that sales pitch for pure, unbiased advice? Well, we fall right into one of the most common traps in investing. It's something called borrowed conviction. You see, when you buy a stock just because you saw a public report, you're not investing based on your own needs. You're acting on a piece of marketing that was designed to help the analyst's firm make money. Their goals are not your goals. And this all boils down to that powerful idea I just mentioned, borrowed conviction. Sure, anyone can click the buy button because some famous analyst said so. That's the easy part. But what happens next? That's where things get tricky. And here's how it almost always plays out. You buy the stock, feeling great. A week later, the market gets shaky and your new stock drops 10%. Now, since you didn't do your own homework, you've got nothing to stand on. Is this a temporary dip or is the company in real trouble? You have no idea. So fear kicks in and you panic sell, usually at the absolute worst time. Real conviction, that only comes from doing the work yourself. Okay, so if that's the problem, what's the solution? How do we build that real unshakable conviction? Well, it all starts with doing your own homework. And that work really stands on two main pillars. And don't worry, this isn't about becoming a Wall Street genius overnight. It's just about understanding the two sides of every investment story. First, the hard numbers. And second, the story behind those numbers. So the first pillar is quantitative analysis. Big word, I know. But it just means the numbers. This is where you look at the cold, hard facts, the balance sheet, the profit and loss statement, the cash flow. These documents tell you in black and white the financial health of a business. The second pillar is qualitative. This is the story. It's the stuff you can't always put in a spreadsheet. How good is the management team? Do you trust them? What are their big plans for the future? What's the vibe you get from their conference calls? This gives you the context, the vision. I know that might still sound like a lot, so let's make this super simple. Let's forget stocks for a minute and use an analogy that I'm pretty sure you're going to get right away. All right, imagine this. You own an IPL team, and you've got a huge decision to make. Who's going to be your captain? You have to choose between a proven legend, Virat Kohli, and a phenomenal rising star, Shubman Gill. How in the world do you decide? You wouldn't just read one headline and go with that, right? Of course not. You'd do a real analysis. You look at the past, Kohli's incredible track record under pressure versus Gill's explosive recent form. You look at the present, their fitness, their mindset right now. And of course, you'd look to the future. Kohli brings experience, but age is a factor. Gill brings longevity and massive growth potential. You have to weigh all of it. And that entire thought process you just went through, that, my friends, is fundamental analysis. That's it. It's not about one single opinion or one headline. It's about building a complete 360-degree view of an asset, its past, its present, and its future, so you can make a truly smart decision.
Okay, so let's bring this all together. What is the one thing you should walk away with today? It's actually pretty simple.
The point here is not to just ignore those sell-side reports completely. Hey, they can be a great place to get new ideas, but they should always be the starting point, never the finish line. The real goal is to build your own skills so you can take that report, question it, check it, and then decide for yourself if it actually makes sense.
So I'm going to leave you with this one question. Take a hard look at your own investments. Is your portfolio built on the solid rock of your own research, your own conviction? Or is it built on the shifting sand of borrowed opinions? Because trust me, the answer to that question makes all the difference in the world.